Hi, and welcome to my friends across the pond. Market sure has gotten a little bit interesting, so I thought we would start with looking at the economic modern family created by moi, Michelle Schneider, Mish at marketgauge.com. So what you're looking at right here are the weekly charts, and I think I showed them to you last time because what's so interesting is that you have not all, but most of them trading above the 50 and the 200-week moving averages. You have the negative slope on the 50-week moving averages, and yet you also have some clear outperformers versus what could possibly be flashing warning, just like we talked about. So to follow through, we're going to start here with the retail sector, and of course this is my granny retail. And what's interesting and what strikes me at this point with all of the news, Powell testifying, not that I really would have expected him to say anything that we haven't already heard, but also we have jobs numbers coming out Friday in the States, and then next week CPI. Consumers have been hanging tough, even though we've obviously seen stress from the peak that we saw back in early February. We're having an inside week to last week, which makes a lot of sense. So that kind of also makes it sort of easy that if you look at the range from the week before, the high was 67.47, the low was 64.98. That tells you 64.98 not only breaks down under the 50-week if we happen to close below there, but it probably means that under 64, which would be the next stop, we're going back into a negative phase. It would be a distribution phase. And also it would mean probably a lot of pressure that all the talk about the consumers being strong, not necessarily true, particularly XRT, which covers a nice breadth between e-commerce, brick and mortar, and then various types of consumerism. If we move over to IWM, Grandpa, this obviously has also held above both of the moving averages, putting it in a weekly bullish phase, is also having an inside week, although it doesn't look as pretty as Grandma's. And so again, we have to look at the range of last week, and that low would be 186.12, and the high would be, let's just round it up to 192. So as long as we're in the middle of this range, even if it breaks down under last week's low, we still have obviously support all the way down to around 182. So when we talk about a range-bound market, you can see what's happening. We get closer to support and the buyers come in. We get closer to resistance and the sellers come in. And if that frustrates you, it should, but it also has to prepare you for not chasing rallies for too long, or what we call trim and tail, and certainly not getting too bearish at the lows. Now, of course, biotech, we talked about, had broken down. What's interesting here is that we're getting two inside weeks. So it had this huge move lower a couple of weeks ago, and now it's in consolidation mode within that range. So when you have two inside weeks, you look to the second week for the range to break. So that puts us in a situation now where if we can get back over, say, 131, that would obviously be a positive. We'd have to get through this 200-week up here. And if we break down, let's just call it an even 126 because of the 50-week moving average, biotech is going to take another sharp move lower. And that doesn't necessarily have much effect on the market because we've seen biotech trading in its own universe, but it certainly tells us that not only are we possibly going into a tougher economic time because biotech is speculative, cyclical and non-cyclical, in that non-cyclical means that generally it can withstand recession, but also cyclical because obviously R&D and hiring is much greater in a better economic time. Now, semiconductors continues to be the star. And if you're looking at the board today in the US, you're seeing stocks are up that are in the chip space, like Advanced Micro Devices, NVIDIA. But one thing I know for sure is if the rest of the market falls, semiconductors can only hold up for so long. However, they would be probably one of the first places you might want to look on any kind of substantial dip. So at this point now, we have the 50-week way below at 222. If we don't get there, let's say we get down to around 230, and when we look at the SPY, that also stabilizes back down at around, let's say, 3,800, 3,900, then maybe that would be an opportunity. But one thing I would say to you right now is looking for opportunity amongst all this volatility could get you chopped up. So it's good to be patient. At least what we're seeing here in our economic modern family is telling us that we're smack dab in the middle of the range, the big range that we established in early February, and it's a very uncertain market at this point. And the other stronger performer, of course, is transportation. And if you look at an ETF like JETS, which includes a lot of the airlines, they're still doing well. So here's where consumerism has actually held up, and that's really been in the travel and leisure space. And so again, would I be a buyer right here? No. Would I almost at this point prefer to see new highs to get excited? Yes. Or another dip down to around 225 area, even 225, figure 227, and then maybe would take a bit of a bite there out of some of the transportation stocks. And the weakest one, the one that is really concerning the most here, are the regional banks. So regional banks are important because they're really the habits of people within more rural communities within the United States as opposed to the big banks. So in this particular scenario right here, what we're seeing is, first of all, people aren't depositing money in savings accounts, partly because they've been using a lot of the money to run up credit card debt, but also possibly because the interest rates that banks are giving you on savings accounts are not competing right now with CDs, for example, which are giving about 5%. So the banks may be forced to raise the interest rates that you receive on depositing money, in which case, of course, then they're going to affect the bottom line for bank profits. And we know how hard that is for our prodigal son to admit that maybe they've been overzealous. They always come crawling back for forgiveness. So technically speaking, again, we didn't quite make it here through all this resistance, and if you look at a 23-month or 2-year business cycle, we didn't even get close. And now we have the threat of this 200-week moving average, which was under siege in December, had the nice pop. Maybe this time it'll hold again. But if it doesn't, regardless of everything I'm telling you right here, I would say that you look at XRT and KRE to either hold or not. And if they don't, then I would certainly be very cautious, at least in the world of equities. Unless you're such a good stock picker and you're looking at a sector, which we're going to talk about, that could outperform for more fundamental reasons, I'd be cautious. If anything, I would even consider maybe the short side. I also want to show you the S&P 500, and I like to do it on my TradeStation chart because I get the 4 time frames all at once. So here's that 23-month that I keep talking about that it got right up to and failed. Because yes, we're not in a growth cycle. We're still in, as far as I can see, heading towards a stagflation environment. We still have that strong jobs report, but nonetheless that we know could change, especially when you hear announcements over and over about big companies like Meta laying people off. That used to be bullish for a company, and right now it's acting bullish even for Meta, but how long really, of course, remains the question. So here's your 380, 370 level that I was talking about on the monthly chart. But when I say I'm looking for 3,200 possibility, of course I'm basing it on this 80-month, which is more of a 6 to 7 year cycle, business cycle, and it would also tell us whether or not we really are going into a much worse recession, which I don't necessarily believe, or whether this would be an incredible buy opportunity across the board if it holds. Here you are on the weekly chart. We still haven't, just like I showed you with IWM and XRT and SMH and IYT, we haven't broken down under that 50-week moving average. So I like this 400, 390 level as a pivotal level. And if it breaks, that would be caution. And on the daily chart, you can see that, again, we're also still above the moving averages. So right now what we're doing is reacting probably more to the fact that A, we couldn't get through the top of the range, and B, there's some hawkish talk around. And if we just take a look at the interest rates through the TLT or the long bonds, what is so interesting is that you had This isn't a classic island bottom because an island bottom happens at new all-time lows or new all-time highs classically. But this is definitely a classic exhaustion gap, which many will call an island. Is when it gapped lower and then gapped up, and right now is confirming. So this gives us different information. This means that the long bonds are anticipating that the yields could potentially soften, not necessarily the yield curve, but the long bond yields could soften, which also might be an indication that the market is preparing itself more for a harder landing or more of a recessionary landing, in which case, interestingly enough, a flock to bonds could very much be a thing. And if we go to the dollar held clutch support at 104, which is exactly the area it needed to. And if we can get through up over this 50-week moving average here, or up over 106 and the dollar goes up, of course that's going to be stressful to the markets and also to commodities. But at the same token, it also means that in the face of everything that you're hearing in terms of the dollar potentially being under siege with BRICS and all of the rest of it, China and Russia, the dollar is still, the United States and its bonds still are the safety play until that changes. So now just moving for a quick view, I don't want to spend too much time on this, but looking at gold is well outperforming silver. And we know that last week steel, which by the way, the Steel Dynamics company that we talked about is still in the green. Aluminum is down, but not nearly by as much as one would think. And also copper, of course, taking a little bit of a hit here today, but still well above where it broke out from. So we are seeing a correction in commodities based on the stronger dollar and the threat of rates. But again, one misstep by the Fed, which I think is very, very likely, just because he's testifying today, Powell, doesn't mean that anything for what happens at FOMC, which will be at the end of the month. But nonetheless, here we are in a gold chart, also an inside week, also above the 50-week moving average, also still above its 23-month. So I still feel that gold on any substantial dip is going to look like a buy longer term because of all the geopolitical concerns. Now it's starting to underperform the SPY, so I wouldn't rush by any means. And we can see in our momentum indicator or real motion, which is our stock charts ACP plugin, we've failed the 50-day moving average. So it's not like I would say run in and buy now, but I would certainly think if we get anywhere near the 165 to 167 level and show any signs of promise and consolidation, particularly if this holds up against the SPY, that would be your opportunity in gold. So since people are looking at some other buy opportunities, let's talk about one that I talked about last week, and I'm going to give you a couple of other commodities and some equity picks. So here's our natural gas. So natural gas, this is a weekly chart. Let's go to a daily chart here. And on the daily chart, this is so typical of natural gas, right? Just gaps. But what's so interesting to me about this is that I talked to you and I said that it needed to hold 840 as its first place. Yesterday's low was 837 and now it's up a little bit. And 8 was the ultimate support. This was after it made its big move when it cleared 9 and looked like it was going to go. But you can see that this 50-day moving average is extremely important. This is why I love to talk about phases. So right now we're still in a bearish phase. We had a nice big pop with a correction. Now what you want to see is this gap to be filled to 925. If it fills the gap to 925, I think you have a pretty good risk to under the low of 837. And then you can see if it's got more fumes. Right here, right now, I would probably do, like everything else, kind of be a little bit more patient. And momentum is broken down back under the 50-day moving average, but then again, it's still in a stronger position compared to its price. And the other commodity I want to show you here is one that I'm actually going to be covering, which is corn. Now, this is not futures, this is corn ETF. But nonetheless, this day right here was what we call a bullish reversal pattern. It makes a new 60-plus day low, and then it closes within the top 25% of the day range. It took out the high here last week, and now is trading below it. But nonetheless, this to me, if you look at it and you blow this up a little bit, there's a little teeny bit of a gap here to 25.48. If corn can get through 25.50, you have a really good risk to underneath this low of 24.83. Give it a little fudge. And that's actually, if you can get essentially a 70-cent risk in this corn, which has an ATR, I believe, at about 60 cents maybe. I'll have to take a look. Hold on. I'm going to look right now. Corn's ATR, excuse me, is actually 34 cents. So you basically would be getting a 2 ATR risk, which is what we like to look at. Then again, this would be something, as we're getting into seasonals and growing season, any natural disaster, any geopolitical stress would send this flying. Now, right now, again, patience has to get back over the performance on the SPY, and yet it did have a mean reversion. It just hasn't gone far enough yet. And the other commodity that I'd like to show you is one that I've shown you so often. And in the face of everything going on as I'm talking to you, there is sugar represented through cane, and this is the ETF. And right now, we could see a reversal here at the Bollinger Band if it cannot close above it. That's happened before. But right now, we're so well outperforming, and we certainly haven't had a mean reversion in the Bollinger Band on the momentum indicator. We're still underneath it. So I wouldn't necessarily be chasing it here, but what I am looking at is the information this is providing, that regardless of what's going on, sugar's on its own tear. Okay, so let me give you 3 stock picks that I would be looking at this particular time from 3 different sectors. So the first one is Rumble On, and basically I've been doing a lot of research into the entertainment field and what could possibly take off, but it has to be sports and entertainment more involved with global situation. Like, for example, in the United States, The Rock has started XFL, but that's really a United States thing. So I was looking for things that are more global. And Formula One, for example, is another great indication of a stock. It made a huge move last week and, of course, is selling off with the market. But I also wanted to look at this Rumble On, and you can see, because what are going to be global? Soccer, fights, race car driving, particularly Formula One driving. Those are the 3 that come to mind immediately. So in the Rumble One, we're not quite there yet, but I want you to write this down as a potential trade, because first of all, it looks like it could easily, if it holds green, take the leadership role against the SPY. On a momentum basis, it cleared the 50-day. It's sitting right on the 200-day. So the momentum is certainly in a divergence because it's above the 50, where here the price is below the 50. So that kind of makes it simple, right? Sometimes simple is the best. And the best thing you could do right now is look for 2 closes above the 50-day moving average, which also happens to be above today's high. So I would say you get 2 closes above 840. Again, your risk does not have to be great. You could really basically look at the most recent low, would be about under 780. And in this situation, if you can get a move over 840, this could be something you can hold on to for a while, obviously if you don't get stopped out. Looking at your first target somewhere between 10 and 1025 to trim and tail. So that's number 1. Number 2 is actually a country fund. Now, I'm really early with this, but sometimes these sleeper trades really pay off, and of course, as long as I can come up with a good momentum divergence reason, I don't mind. Now, number 1 is this had a new 60-day low. This is what we called a brick wall bottom. The other was a glass that I showed you in the TLTs, because this one had a 2-day bottoming pattern and then the gap. So that makes the risk really super easy. 11.16 should hold, so I'd have a stop somewhere under here. Now, Vietnam has one of the strongest economies, but it's feeling the pinch a little bit in real estate, and obviously nothing will survive a major global recession. But I still think that this is actually really super undervalued. You can see it's flirting with leadership with the SPY. As I just mentioned to you, it's close to the 50-day moving average, but hasn't quite cleared it. So again, a little bit of teeny patience here, but I kind of like this above 1170. And if we can get through 1170, like I said, I'd probably give it a little room to under 11 and see where this one goes. The third one is actually more in the defense area. And this is Northrop. Now again, this 50-day moving average versus the momentum versus the leadership is so interesting to me because, again, talk about a one-day pattern. Here you go. This was a classic last wall. New low, closes near the 25%, never takes out this low, does all this work, and now you can see that it's trying very hard to do something here. It is outperforming the SPY. In the momentum indicator, there's no divergence, which is interesting because that tells you that if the momentum clears the 50-day moving average and the price clears the 50-day moving average, and we like to look for a 2-day confirmation, so let's call it 478, then even though we have resistance up here, what it could mean is that not only are defense stocks, and this one that has been underperforming getting ready to go, but could also really confirm some geopolitical strife. So there's a couple of others obviously around. I mean, if you really want to look at more on the chip space, I've been watching advanced micro devices, particularly as we're in Women's Month here. This is actually a CEO is a woman. You could see right now it's looking pretty good. It's hanging in there. But I'm nervous a little bit about the chip space. It's been really going mainly on speculation about massive production of chips in the United States. Assumption nothing happens with China and Taiwan, and also based on the fact that this is interest rate sensitive, obviously in this particular area, that the interest rates are not going to kill this. But nonetheless, 75 is your rock bottom low, and you can see we're doing all this work here. I would say basically we can get through 83.50. If you wanted to play in the semi space, that might be where I go. Okay, that's it for now. Thanks so much for watching. You all have a great weekend. This is Mish signing off. Bye.